All right, European rescue rumors fueling today's market rally. However, my next guest says if the rescue plan doesn't happen, it could tip us, the U.S., back to recession. Joining me now is Mark Lamkin, the CEO of Lamkin Wealth Management. Hi there, Mark. All right, you just heard our breaking news here on Fisher's comments that Operation Twist, really not a good idea. He voted against it, works against job creation, encourages people to continue to hoard their savings further, not throw out that money into consumer spending, which would obviously boost the economy. What are your thoughts on that, and how does it all affect your investing strategy?
Well, thank you for having me, Lori. And I tell you, Operation Twist is like a bad Halloween prank. It was just enough to put people in a bad mood. I really don't think it's a great. It's not going to impact the Treasury yields one way or the other. Treasury yields are going to trade on the economy and the markets. I think the significant language in there was much more important, and it opens the door for a QE3. So I think it scared that. I think it scared the economy. I think right now, uncertainty overweighs optimism. We've been in a trading range. And let's face it, if this European TARP deal happens and the U.S. Super Committee actually comes to $3 to $4 trillion, I think we'll surpass 12,876, the earlier year's highs. If both those fail, I think get your Dow 10,000 hats. If one of the two happens, we'll be stuck in this trading range until we start creating jobs. So I'm watching it very closely.
So you mentioned treasuries. You don't like them. I know that's on your avoid list. So usually we, ask you to give us some investment ideas. But let's start with your areas to avoid first.
Yeah, I think treasuries are overpriced here. I think that fourth quarter, I think GDP is going to surprise to the upside. I think U.S. auto production and sales are nearing a 3-year high. I think the fourth quarter GDP could actually equal the first 3 quarters combined. So I think that's going to strengthen yields in treasuries. You don't want to own treasuries here, in my opinion. We've also had a pretty darn good run in municipal bonds right now, so we're curbing our municipal enthusiasm right now. We're taking some profits right there, and I still don't like developed international. This TARP deal scares me. I don't know how much contagion we've got. Let's face it, Greece had $200 billion in debt. Because of Greece fears, we wiped out $3 trillion in the market. I don't know how far this can go, so until that gets cleared up and we have resolution, not necessary solution, I'm getting away from international stocks right now. All right, as far as where to put your money, if you are looking for yield, the bank loan sector offers an ETF you're in favor of. Tell me about that. You know what? I really like this sector. After the Fed statement in Operation Twist and the significant language, rates may stay the same to 2013. And with that recession word out there, it was a crowded risk trade. Bank loans sold off. BKLN, for example, was off almost 10% in August with not an increase in defaults and interest rates. I think they're selling for about 92 cents on the dollar, and you get an attractive yield right now play. So some cap appreciation and yield if I'm wrong. Second, I think J&K, the high yield market, same thing. Crowded risk trade. Supply and demand imbalance, in my opinion, got unfairly punished. You get 7 to 8% while you wait with that as well. So I think those are two good plays for kind of a sideways trading market until we get some of these issues cleared up. Okay, so just for our viewers, the J&K you mentioned is a Barclays Capital High Yield Bond ETF. Before that, you had the BKLN, that was the bank loan senior loan portfolio. So are you worried at all about credit markets? We saw such a tough month in August. I mean, just talking about the very, Main Street, regional banks, if you will. How does this all trickle down in your view? And do you expect lending lines to loosen up a little bit, people having a little more access, easier access to credit? Yeah, that's why I think the Fed Operation Twist isn't a big deal. I don't think we have a money issue. I think there's plenty of supply and rates are near historic lows. I think it gets to bank balance sheets, and I think the Fed may have to get to a situation where they charge for reserves to encourage this lending. Let's face it, to get to 2 to 3% GDP, you're going to have to put money, you're going to have to put gas in the tank. As far as, I think company balance sheets are cleaner than they've been in probably in my lifetime, the 22 years I've been in this. That's why I think defaults are going to stay very low, because corporate balance sheet and company earnings are near record highs. Even if earnings don't grow, I think companies are very strong, and defaults are going to stay at a very low point, in my opinion. All right, we sure appreciate your opinion. Mark Lamkin, great to have you on the show this afternoon. Thank you for having me.